Southern Connecticut right now. So.
Oh, you're gonna play some golf?
Yeah, a little bit. We're hoping to play at least a few rounds. So hoping that the weather's decent.
How long will you be there?
We're going to be there a week.
Oh, nice.
Yeah. Have you been there?
Oh, yeah, we go often. My in-laws live there.
Oh, okay. Nice.
Yeah, I was there in November.
Oh, nice.
You fly or drive?
I hear
Mine's on.
the Cambridge Trust people clearly, but I'm having a hard time hearing Chris when he speaks up. So
Test
I don't know
1
if
2
the
1 2.
microphone's close or whatever to Chris, but
Okay.
having a little hard time hearing Chris.
Test 1 2. Ooh, that is plenty loud. Can you guys hear me?
Yeah. Very much.
How about the callers? Can the callers hear me?
My microphone? Okay. Good morning, everybody. Can everybody hear me?
Yeah.
I can hear you, Chris. Yes.
Oh, okay, good. And you're good. So we're almost ready to start. In fact, I have 9 o'clock now, so we will call the meeting to order. Welcome everybody to the March 19th, 2021 meeting of the Merrimack Trustees of Trust Funds. Our first order of business, as usual, is to make introductions. So I'm Chris Christensen, chairman of this outfit. To my right is,
Jack Balcom, board member.
and by my left is,
Tom Boland, Deputy Finance Director for the Town of Merrimack.
and by telephone, we have trustee Bill Wilkes. And
Bill Wilkes, trustee.
people from Cambridge Trust Company. I'm not sure exactly in total who's there. So if you guys can speak up, we appreciate it.
Sure. Susan Martori Baker.
Eric Chusome.
Lindsay Donovan. Judy Noel.
David Lynch. Good morning.
Okay, good morning, everybody.
Good morning, Chris.
And you'll pardon the pauses, but I'm taking minutes as we move through everything, so if there's silence, it's just the squeaking of my pen. First order of business is the minutes of February 19th, 2021. Do we have a motion?
I move we accept the minutes. Can
Second.
Okay,
You can hear me okay, Bill, right?
Yes, I can, Jack.
Oh, good, okay.
all right, so moved by Jack, second by Bill. Any omissions, corrections, additions?
We already made those.
Hearing none, all in favor?
Aye.
Aye.
Motion carries 3-0-0. And the next item is a presentation by Cambridge Trust on changes they've been making to the portfolio of late. And what else we got here? Give me just a second. Some of the future outlook. Possibly consideration of some language changes that would be coming up in a couple of months on the investment policy. And And I think that's about it. So, Judy, or whoever is going to lead off from Cambridge Trust, you've got the floor.
Great. Thanks very much, Chris. It's Susan. Thanks again for inviting us all to attend the meeting today. As you know, we really value the relationship we have with the Town of Merrimack trustees, and we appreciate your relaying the concerns that the trustees had. This morning, we want to address those issues and let you know the current status of the portfolio, and then discuss next steps. As you said, we want to confirm the investment policy guidelines and the trustees' expectations going forward. So with that, I'll turn it over to Eric to review the 2-page executive summary that you received yesterday.
Great. Thank you, Susan. Good morning, trustees. So as the executive summary states, we have taken action over the last several months to increase the yield to the portfolio. As you can see, the scholarship, so as of March 15th, the yields have increased from November 1st, most cases between 40 to 60 to 70 basis points, depending upon the account. So the equity yield for all three accounts is now about 3%, 2.95, 2.96%. Substantial increase in the equity yield. We've made a fair amount of trades. We reduced, several positions, eliminated positions, and increased the overall yield to the portfolio in accordance, with your desire to have more income coming from these portfolios. As well, the overall yields of the portfolio are being diluted a little bit because of, bond yields are still quite low. Bond yields are actually lower than equity yields right now, and we've actually increased your equity allocations, from where they were back in November. Scholarship right now is about a 76% allocation to equities, and so the bond yields are what's basically diluting the overall yields a little bit here, and specifically within scholarship. Just to note, that overall portfolio yield is 2.69%, but there's about $10,000 of accumulated income that's sitting in a money market right now, earning that 1 basis point. So if that was subtracted out of that equation, the yield on that portfolio would be 2.78% right now. So that just shows you, several years ago, money markets were paying 2.5%. The 0.01% right now is actually a drag to overall portfolio yield. So I just want to address, we understand, your needs and your desires, and we've made we've taken the measures with which to increase the overall yields to the portfolios. And just to highlight, the common funds for principal, the overall portfolio yield for that account is 2.82%. And for the common income portfolio, the overall yield on that portfolio is now 2.77%. So all three portfolios now have a yield higher than where they began on January 1st of 2020 from the analysis that we've run. So, we've definitely, taken, your comments, and we have, made the changes to increase the yield to the portfolio. And going forward, we anticipate not as much turnover as we've had to realign the portfolio to increase the income. We're not going to be making, market decision trades. The intent is, the equities that are that are held right now in the portfolio can be held through longer market cycles. We may add, we may have some additions to the portfolio as our analysts are continuing to look for higher dividend paying stocks. When those have been approved, we would look to add those to the portfolio as well, with the goal of continuing to increase the income.
Sounds good to me.
And I
Jack,
think for the...
I'm sorry. Let's hold right there. Bill or Jack, do you have any comments up to this point?
No, it sounds like both issues were addressed.
Bill, are you still there?
Yeah, I'm here. I mean, my comment would be, that I would hope that we don't turn the portfolio over as much as we have in the past, that we don't need to, and we're yield-oriented, dividend-oriented, so there's no need to be trading as much, which I think you kind of said that, that's going to be the way you're going to operate going forward. You know, what would be important to me is if, you know, if you have a security that you think the prospects aren't good, then sure, you know, we would expect you to make a change. But, you know, we don't want to sell Procter & Gamble just to trade into something differently. I mean, but if Procter & Gamble, you saw something that didn't look good going forward, then we certainly would want to make a change. So we just don't want to see a trading mentality.
Yes, and that is our goal, is to limit the amount of trading, especially what happened during the first quarter of last year, where we're not going to be making, you know, these, you know, market type of little adjustments here and there. It's going to be more, you know, if there's a concern about the company on an ongoing basis, we would, you know, obviously would look to sell that position. But I think, you know, the goal is to continue to hold positions that we continue to like, and, you know, if opportunities present themselves with which to increase the yield of the portfolio, we will continue to do that.
Tom, did you have
That
anything?
sounds good.
Anything you want to comment on?
I guess my only comment would be, you mentioned the kind of the overweight in the scholarship fund on the equity side. Does it make any sense to look at shifting any weights in any of the other in the common funds? I don't know, but I'm trying to understand the rationale for any investment or any significant investments in bonds right now. There's nowhere for yields to go for the most part except up, which is gonna have a detrimental effect. Does it make any sense to shift more weight into equity in those funds?
That is something that we can do, but just, you know, our bond portfolios are typically, you know, running neutral or slight underweight to duration versus their benchmark. So we do have short-term securities that would be rolling off. So if rates do continue to rise, we would have reinvestment opportunities that would hopefully, you know, be higher than where they currently are. That's the goal. So, you know, I think we do have some cash, and as bonds, you know, come due, you know, we will make that, you know, decision as to, you know, what the ultimate, where the best yield is. And I don't think we want to increase the policy allows us to go up to 90% in equities. You know, I don't know if we want to go exactly that high yet, but I think, you know, we've moved the strategy, the portfolios higher from where they were in their overall equity allocations to try to achieve the higher yield. As I said earlier, you know, you're seeing higher equity yields right now than you are in bond yields, but it's not without risk. You know, we could see, you know, some sort of we could see volatility increase in the markets, but, you know, the goal is to, you know, optimally continue to increase the yields to the portfolios, you know, be it if that's coming from equities or if that's going to come from the bond side.
So yesterday, the 10-year was, I think, 1.7, which is pretty high over the last few years. Do you have a comment on how that influences your kind of thought processes?
Well, the 1.7, that's a 10-year security, and it's mostly the longer rates have moved higher, whereas short rates really have not moved all that much. So the front part of the curve is really being anchored by Fed policy. So in contrast, if you look at like the 2-year Treasury is about 16 basis points, and the 5-year Treasury is just under 1% at about 88 basis points. So I think if we see, you know, in the spread market via the agencies and corporate credit, you are getting over 1%. So on credit right now, you're getting closer to 1.5, 2 if you really, you know, find a gem here and there. But, you know, I don't think at this, you know, we're not willing to go out necessarily right now and lock in 10-year yields at 1.6, 1.7%. If those were to move meaningfully higher, you know, 2.5 to 3%, I think that's a different discussion, because even at 170, that yield is still lower than where we began 2020. So we're definitely have moved off of the lows achieved last August, when the 10-year was at about 60 basis points, but we're still lower than where we began last year.
What's your philosophy on preferreds?
We haven't purchased, we haven't been active buyers of preferreds, but that's an area we're looking at. You do get the current income, but those tend to be perpetual, so there's no real defined maturity date. There are there are some, optional type call provisions provided. So they tend to behave, as a longer dated security, like a longer dated treasury, a 30-year bond with duration aspects. So you can get the current yield, and, it's something we're looking at right now as an option to increase the yield, taking bonds down and buying some preferreds, because it would act as a bond surrogate.
Yeah, that's what I was kind of thinking. I was thinking from a standpoint of fixed income that, you want short durations, obviously, so that you don't lose principal, or don't suffer any major principal loss.
Would the
Yeah,
investment policy need to be changed in order to put any type of securities like that in the portfolio?
That's actually a great segue, Susan. So the policy where, David Lynch is on the call as well, and I think he's going to address a lot of these, but we do need to have a rewrite of the investment policy, because the way it's written right now, there's no, we want to have a little more of tidying up of the policy as to, what is allowed and not allowed, with ranges. So I think with that, I'll turn it over to David to, kind of address, the rest of the, executive summary with the IPS.
Okay, thank you. If you were here, you'd see me nodding in agreement, not sleeping.
Yeah, so I think that's the next step. I guess sort of maybe near the last step, I guess, to round out the picture, to really lock in and crystallize the need and goal for income in the portfolio, even if that means a little bit less of a total return mindset. Not completely foregoing it, but to just, we think between all of your guidance up to this point, we're clear on it, but we do want to tie out the investment policy statement because things like total return are still referred to in there. So we're going to work next to help suggest some language for your consideration that we think would help close the loop fully on that. And then that would be a good time for us to discuss things like whether there is an appetite for high yield bonds of the sort of more traditional kind, whether we should consider things like preferreds. I think some of we don't have an active research effort in preferreds. It's something that we could take a look at. We may consider using an ETF or a mutual fund to do that in a more diversified way, if we were to go in that direction.
The PFF is one of the biggest ones, so you could start there, and you can look what they have in their holdings. So, that's
Yep.
And my
I think
recollection
that
is,
leads right into what you just said.
yeah, I think the yield on that is close to 5% now.
Okay.
I'm sorry, didn't mean to interrupt. Go ahead, Dave.
No, I think that's generally summarizes where we're at, and just making sure that all of you are comfortable. It sounds like you are, but we want to kind of make a fine point on that you're comfortable having a high degree of equity exposure, because in our internal debates, some of the discussion is around bonds don't have as much. Bonds have a challenged outlook from here, but nonetheless, the downside case for bonds is typically not terrible, particularly if you're owning things in the front of the yield curve. We could see bonds down mid-single digits, sort of thing. Equities have more of a two-sided profile, as they do sort of always, but maybe even more profoundly now, because so much of their rally has been driven by low interest rates. And I don't know that they can sustain these heights if we do get a further backup in yields. And so I think there are cases under which equities could be down 10 to 20%. And I think correct me if I'm wrong, I think where some of that comes out is that there is the understanding of that but also the patience and kind of tolerance for that. As long as the dividends are accruing and paying and coming through, that the committee is able to tolerate those temporary drawdowns on the idea that over the long term that potential drawdown should and could be made back with patience. Is that a fair assumption or a fair summary? Excuse me.
Yeah, that's a fair assumption, and I think, we're looking for the dividend aristocrats, the ones that, have consistently paid dividends for, 10, 20, 30, 40 years or more. So we're not emotional about a little bit of volatility in the actual market price of the security. And, I think over history, it's been proven that, those type of companies have done well. So I don't think there's a big concern. I just think that for whatever reason, CTC drifted a little bit away and got involved in some of the ones that were more, popular, if you want to call it that, or, the momentum stocks. And, that just wasn't anything we were interested in. So, and we certainly didn't want to see a lot of trading, and we don't quite understand why there were a lot of small lots traded. The portfolio is big enough that you could pretty much have round lots.
Yep, understood. And I think part of that was the unprecedented pandemic and us trying to make sure we preserved capital as best as possible. And you can, with hindsight, say that some of that was splitting hairs a little too finely, perhaps, with some of the smaller lot trading that we did as we tried to rebalance sector exposures and things like that. And that is on the books, and we'll sort of dig our way out of that. And
yeah, I mean, it's Monday morning quarterbacking, but if the portfolios weren't even touched, I think they'd be, at the same value or more today than they were, when the pandemic hit.
Well, I have to sort of run the math on that. Sounds that way, based on the way the market has moved. But what we just want to tie out for everyone's benefit is that the investment policy does mention things like expecting us to beat the S&P 500, and so some of our maneuvers were an attempt to, in reference to the S&P 500, and I think part of our updated investment policy statement would like to refine language to make sure that it's sort of over a very long term and more of the full cycle concept as opposed to any quarter or any year of judgment, and then also to evaluate which benchmark is appropriate, and that it's I think we've all kind of come to the consensus that we should consider locking in something non-S&P, if you will, and there's a few different dividend benchmark flavors out there, and we're likely to work with you all to pick one to again put in the investment policy statement in the, I guess it's the middle of this year is when you are needing the update from us.
That's right, because we have to review and approve and make an annual approval of the investment policy and turn it into the state in September, or September 1st. So that's kind of our goal, but we don't meet in July, so we're trying to do this pretty much in June, or have it wrapped up in June. When you talk about the volatility, I look at some of the stuff in other portfolios that I work with, and stuff that I bought in 2018, or that you bought in 2018, when the Dow was 18,000, or 2016, and now it's 33,000. And if we lose 10% on the Dow or the S&P 500, well, so what? We're so far ahead of where we were before that those kind of fluctuations just don't really fit into a trading picture for us. Okay, that's understood. We'll look to kind of get that
incorporated in the document, and away we go. So I'm glad that we've kind of worked. I know it's been challenging. We appreciate your patience and your willingness to explain yourselves and kind of repeat yourselves a bit to us. But we have heard you, and we'll keep it front of mind for the future for sure. And I think some of what Eric had mentioned, what you all have mentioned, is there has been aside from March during the pandemic when there was trading for market-related reasons, there has been a higher degree of trading lately to get the portfolio trued up back in line with what we're discussing here today. There may be a little bit more trading to complete some of that rotation and sort of evolution toward higher income. Our goal and understanding is to sort of taper that trading down in the medium and longer term, but there may be a couple more sort of transactions to help get things to the steady state that everyone is aiming at. So I'm just sort of mentioning that should you see a little bit of short-term trading to nudge us more in that direction, it is our intent that once we get to more of that steady state that we will taper things down.
Okay, sounds good. My next note on the agenda has to do with the scholarship fund, and this doesn't directly affect Eric or Dave, but Judy and Lisa and I have been talking. The scholarship fund has a footnote where we put some of the income in 2018 into the principal side for a little bit better return, because it's such a small fund, it's hard to mess around with it very much. And because we have the Watson Fund, which is expendable as opposed to principal and interest only, we've need to refine that footnote so that it's more reflective of what's going on. So just so everybody knows that we're working on that, and I don't think there's anything that needs to be addressed today, but it's just a piece of background information that we're aware of that. In the meantime, the next item on the agenda is correspondence, and this morning's email, I got a quick update from the library trustees. They've sent us the new or the completed Barry Quimby Memorial Fund, and we haven't had a chance to read it and digest it. We'll do that over the coming months, but so everybody knows, the fund has $29,000, $29,400 in a DCU account, and income in that account of 1101. So that income will get the library started on having some spending money for the first year. They also have an account at Fidelity with $10,000 in Middlesex Water Company.
Right, yeah, that was gonna be my question.
And I know nothing about that, but presumably that's certainly,
So that's in addition to the 29,400?
yes.
Okay.
And that's obviously not a very diversified account, so we'll need to discuss and figure out how we're gonna manage that. But I just want to know, that $40,000 is probably gonna show up soon.
Okay, I noticed that they mentioned Cambridge Trust in the letter. Does that mean that it'll always stay with Cambridge Trust? Or
Well, there's
does it
some
move
language
over?
about that.
I see, okay,
If we leave Cambridge Trust, then they have the opportunity of withdrawing the funds
I see.
or approving the new bank. But I don't see that, that's just,
Yeah, I didn't see that language.
yeah. Well, I'll refresh people's memories. We have
Okay.
trust funds or bequests that said the money will be deposited in a passbook at the Amoskeag Savings Bank. Well, nobody has passbooks anymore, and there's no Amoskeag Savings Bank anymore. So, sometimes people put stuff into these trusts that don't have an exit. This one has an exit strategy.
Okay.
So I don't know if anybody has any questions on that, but that'll be coming up, and we'll try and figure that out with the library trustees. I think what we need from Cambridge Trust is some information on the easiest way to, or the mechanics of getting those funds transferred from DCU and Fidelity to Cambridge Trust. So if you have thoughts on that, you can, I'll email all this stuff to you, to Judy, and we'll get back together on that in the next few days.
Chris, I'm happy to work with you on that if you would forward that over to me.
Yep. You will get it, because we'll need some letters of instruction to wherever,
Right.
and press on. And I think that's it. Other correspondence, I just want you to know that we've paid off all of our scholarships, so any cash that's sitting in the scholarship fund is short-term available until probably December. So if we have cash that's making 1 basis point, and we find something that'll make a whole percentage point for 6 months, that would be a possibility.
Okay. Is that you, Lindsay, that oversees those accounts? No.
I don't think so. I don't know. I'm not gonna worry about it. So other than that, we don't have anything else on the agenda, except upcoming meetings. We're scheduled to meet with the town council, April 22nd. Our next meeting is April 23rd, and then May 21st.
Okay, I have a question. What does the town council want to hear about?
They just, nothing in particular, they just wanna, have us review what's going on.
Oh, okay, so they're gonna, so we're gonna update the new policy, or?
Well, we have new elections in April 13th,
Oh, okay,
so there will be presumably a couple of new town councilors, and they've probably never heard of trustees of trust funds.
good point, good point.
While we're talking about, and I'm gonna backtrack a little bit, the investment policy. This is for you, Tom, in your capacity as treasurer. The town has their own investment policy. Some years ago, when we started this one, we incorporated that into the first several paragraphs. And at that time, we were instructed as trustees that our investment policy was for the town as well. And it seems like you guys, or the town council, has continued generating their own investment policy. So we probably need to take a look at that and see if those
Make sure
paragraphs
they're
that
still
apply to the town
match up.
are either still accurate or could just be completely deleted. And if we can maybe talk to the treasurer about that next month,
Okay,
that would be helpful, I think.
all right, I'll take a look at that.
Does anybody else have anything else? Your turn, Jack.
Oh, I move that we adjourn.
Thank you. Second?
Bill?
I'll second it.
Oh, okay.
You still there, Bill? Guess not.
No?
Okay. Motion carries. We are adjourned.
Thank you, Chris.
I have one question for
Sure,
you.
sure, go
Do
ahead.
you want us to attend the May meeting?
I don't think that's necessary.
Okay.
We'll get together in June, which we normally do anyway. Oh, wait, yeah, I'm sorry. Yes, we should do May because we will be preparing for, paying $1.5 million or whatever it is, 2 million to the town. And so we'll have to have that kind of worked out,
Okay.
for their rotation of capital reserve funds. But I
So
don't,
that would be May 21st?
yes,
Correct.
Okay. At 9 a.m.
Right. And I don't think there's anything spectacular going on, so if you're the only one that attends, Judy, that's fine.
You don't want to review the investment policy statement at that meeting?
We're gonna do that in June. Oh, I see what you're saying. Okay. Yes. If you have something that we should put that on the May agenda so we can approve it in June. Thank you.